What does FTX's collapse mean for the future of crypto? The fall of one of crypto's largest exchanges could have repercussions for regulation and for traditional financial markets. Over the course of just a few days, FTX collapsed. Its CEO and leader, Sam Bankman-Fried, has resigned. FTX and dozens of its related entities have filed for bankruptcy. This stunning collapse has raised questions about the future of FTX and of the broader crypto industry. Welcome to Crypto's Genie, and if you like this type of content, make sure to hit that like button, subscribe to our channel, and turn on notifications so you wouldn't miss out on new updates in the world of crypto investing. The short story is that crypto tycoon Sam Bankman-Fried and the company he founded, FTX, spectacularly imploded. The collapse caused him to lose 94% of his net worth and his title as CEO, but there's a lot more to the saga. The Silicon Valley-born, MIT-educated Bankman-Fried launched his crypto trading firm, Alameda Research, in 2017. 2 years later, Bankman-Fried and his team launched FTX. Bankman-Fried got rich off FTX and Alameda, the two companies netting $350 million and $1 billion in profit, respectively, in 2020 alone, according to Bloomberg. At his peak, Bankman-Fried was worth $26 billion. At 30, he had already become a major political donor, gotten celebs like Tom Brady and Gisele Bündchen to hawk FTX, and secured the naming rights to the arena where the NBA's Miami Heat play. Then in early November, crypto publication CoinDesk released a bombshell report that called into question just how stable Bankman-Fried's empire really was. The report found that even though Alameda Research and FTX are two separate companies, Alameda's assets were mostly tied up in FTT, a coin that FTX had invented. Though there's nothing technically wrong about it, it called into question FTX's liquidity, CoinDesk reported. Just days later, things got worse when Changpeng CZ Zhao, the CEO of Binance, arguably FTX's chief rival, decided to liquidate roughly $530 million worth of FTT. Customers also raced to pull out, and FTX saw an estimated $6 billion in withdrawals over the course of 72 hours, which it struggled to fulfill. The value of FTT plunged 32%, but rallied once again with Bankman-Fried's surprise announcement on Tuesday, November 8, that Binance would buy FTX, effectively bailing it out. Then Binance announced it was walking away from the deal, citing findings during due diligence, as well as reports of mishandled customer funds and the possibility of federal investigation. The news sent FTT plunging even further. Bankman-Fried saw 94% of his net worth wiped out in a single day. Strapped for cash, Bankman-Fried began calling other industry rivals, including Coinbase CEO Brian Armstrong, for a bailout, to no avail. On Friday, FTX filed for Chapter 11 bankruptcy, and Bankman-Fried resigned as CEO. In a series of tweets, Bankman-Fried chalked up FTX's implosion to a combination of high customer withdrawals and his own incorrect estimates of how much debt FTX had taken on. A Reuters report suggested that there may be other factors at play. The news service, citing unnamed sources, said that earlier this year, Bankman-Fried transferred customer funds from FTX to Alameda without telling anyone, after Alameda was hit with a series of losses. FTX is backed by a slew of high-profile investors, including SoftBank Vision Fund, Tiger Global, Sequoia Capital, and BlackRock. Sequoia said this week that it's marking its investment in FTX down to $0. The storied VC firm had invested $213.5 million in total in FTX. It's been a tough year for the crypto market, which suffered a $2 trillion crashback in May. Now the FTX drama is creating a ripple effect throughout the crypto industry. It sent the value of the sector down 12% over the course of a day, according to CoinMarketCap, and stoked fears that crypto is about to have its own Lehman Brothers moment. Industry experts told Insider that the saga might encourage regulators to try to crack down on the crypto industry or make big banks worry of letting customers trade crypto. What's more, the FTX meltdown could cause confidence in the industry to falter further, leading people to withdraw their crypto assets out of fear. Experts call this contagion. JP Morgan analysts wrote Wednesday that it looks likely a crypto reckoning is coming, and experts warned that investors should be prepared. As an investor, you should be seriously questioning what you're investing in if it can evaporate over a weekend. Bankruptcy.com analyst James Royal told Insider on Friday, "The prices are entirely based on sentiment and belief in the future of crypto. If that belief goes away, you've got nothing." The FTX episode may mark another step into the once-and-for-all collapse of these permissionless, privately issued cryptocurrencies. There was certain optimism in the last month that once the dark clouds on the horizon caused by the pandemic and the war in Ukraine vanished, prices of crypto assets would rebound. Now there is seemingly something more structural going on, revealing that given that, in the absence of full acceptance of cryptocurrencies, their price only depends on investors' willingness to hold them. Unlike traditional financial institutions and exchanges, where investors' and depositors' money is protected, crypto exchanges are much riskier. The reason is that, given the nature of cryptocurrencies, exchange users need to transfer ownership of their holdings for their trade to take place, meaning they are no longer depositors but creditors. This is why crypto traders should never keep their holdings in an exchange, such as Binance or Coinbase. Given the volatility of cryptocurrencies, when prices drop significantly, investors sell rapidly. This may render the exchange unable to satisfy liquidation demands by investors, meaning users could have a difficult claim on their crypto holdings. Now, FTX is not just broke, it has sought protection under Chapter 11 in the Delaware Bankruptcy Court, which favors a reorganization with the objective of satisfying creditors' claims. The bankruptcy filing was preceded by a week of panic over the exchange's financial health and a surge in withdrawals, which only made things worse. The final outcome remains unclear. There is, however, some good news to come from FTX's collapse. The revelation that cryptocurrencies might not be the golden hen for unsophisticated investors is a positive development for markets. In market microstructure, these investors are called irrational traders, which are usually taken advantage of by more informed traders. In the past, irrational traders have had too important an impact on prices, which is not desirable for an efficient market to work. Once they are gone, we can end up with a market that prices crypto assets for what they are truly worth. Despite the collapse of FTX, blockchain technology remains healthy and is the reality of many interesting initiatives that are revolutionizing our financial system and our economies. Applications in financial markets, blockchain solutions to price carbon emissions, utility tokens that disrupt traditional internet platforms, smart contracts, and digital assets as financial solutions for individuals and companies. These are only a few of the applications of the technology that will hopefully receive the attention they deserve. As per Crypto's Genie, the FTX crash will cause a significant amount of market negativity. However, this shouldn't have an impact on the long-term prospects of Bitcoin or cryptocurrencies in general. A whole industry's future shouldn't be decided by a few subpar ventures. When investing in cryptocurrencies, please use the utmost caution because the market is largely unregulated and may have an impact on your capital. Hope you enjoyed watching our latest video. While you are still here, please go ahead and click one of these 2 videos on your screen. Also, check out our website and Twitter. Links in description. Thank you for watching.